Everyone is watching the main headlines on tariff wars. Silently, $3 trillion fragmentation is reshaping your portfolio. Today, I'm going to reveal the 5 sectors that are going to win big as rolling protectionism creates the largest supply chain realignment since World War II. Welcome back to StockScope Live. I'm your host, Ali, and I'm going to bring you insightful information that actually matters. Despite fading headlines about tariff wars, something massive is happening beneath the surface. Global geoeconomical fragmentation through unilateral tariffs and non-tariffs are quietly disrupting global supply chain, and it's creating massive opportunities for investments over the next 2 years. The numbers are actually staggering because global trade restrictions have surged 75% since 2016. With over 4,650 import barriers now in place, this isn't about China anymore. It's about sector-by-sector protectionism that is permanently reshaping how the world does business. And we need to get to the bottom of this so we understand where those opportunities lie. Let's start with what most investors are completely missing. While the headlines about main war tariffs between America and China and America and the rest of the world is grabbing people's attention, non-tariff barriers are actually the real threat. Things like quotas, license requirements, product standards, and regulatory restrictions can be more devastating than direct tariffs. Now, here's the shocking truth. The OECD projects that if the current fragmentation continues to accelerate, global output will drop by 2% in the mildest scenario. And this is because of the decoupling that is going on worldwide, especially with China de-dollarization and the BRICS bloc moving away from the US dollar to create massive trades between these massive economies. Now that's $3 trillion in lost trade value by at least 2026, 2027. And consumer prices will rise by 2.5%. That's equivalent to $3,800 additionally per year per household. Some people just can't afford that. You add that on top of regular tariffs, and then you're going to get more money into your spending that you just can't afford. But here is the investment opportunity. This fragmentation isn't random. It's happening sector by sector, creating clear winners and losers. The manufacturing sector is facing the greatest shift, with 58% of electronic goods and 45% of textile goods facing the most changes in their corridors. The automotive industry is also particularly vulnerable because cars cross borders up to 8 times during assembly. This brings us to the second largest trend that's reshaping global supplies: friendshoring and nearshoring. Companies are moving production from more hostile areas and geopolitically risky countries to trusted allies or geographically closer partners. For example, Mexico just overtook China as the largest supplier of US in terms of goods. That's a massive shift. Vietnam faces 46% tariffs, making nearshoring to North America more attractive. Meanwhile, India, Canada, and Mexico are emerging as friendshoring destinations. The investment implications are huge. For example, Atla Gas, a Canadian energy infrastructure company, has built-in protection from the US tariffs and reported record export volumes with 8.6% revenue growth. Canadian National Railway is positioned to capitalize on supply chain disruptions as goods need efficient transport nationwide networks. Now, in the manufacturer space, Nucor, N-U-C-O-R, America's largest steel production, benefits directly from protectionist tariffs. As external steel faces 25% tariffs, Nucor can increase its margins and supply the domestic requirements that are needed. This is exactly what happened during the 2008 tariff cycle between Trump 1.0 and China. Smart money is already rotating into defensive sectors that thrive during this trade uncertainty. Healthcare, utilities, and consumer staples have outperformed the markets in 2025. This is driven by earnings stability and essential demand. Now, utility sectors in particularly are supported by surging electricity demand from AI data centers and manufacturing reshoring. Despite those are being traded at very low price to earning ratios, i.e. PE ratios. Healthcare has demonstrated great resilience this year, with the S&P Healthcare Index significantly outperforming during trade policy volatility. Defense and aerospace stocks have gained traction as defensive plays, fueled by bipartisan support for increased defense budgets. As global security threats rise, more money pours into those sectors. These sectors benefit from long-term government contracts and domestic manufacturing that shields them from tariff impacts. For international diversification, investors have been turning to something new, something that's called sukuk. It's the Islamic financial instrument that has shown great resilience in geopolitical crises compared to conventional bonds. Dynamic asset allocation and liquidity planning are becoming essential tools for navigating this fragmented landscape. And if you want to know more about sukuk and the Islamic finance instruments, I'm going to make a video about this, so watch out for that video when it drops in the next week. Looking ahead through 2026, this fragmentation is only going to intensify. The International Money Fund, the IMF, has already revised global growth by 0.8% and revised global trade by negative 2.3%. The US GDP is also on a downward trend of about 1.3%. But this creates specific opportunities in some sectors. We talked about electronics, textiles, and even machinery. They face the most shifts in their trade corridors. Companies with domestic-focused revenue streams are going to outperform those that have international exposure. Now, the key investment theme for the next 2 years, or until something big changes, is domestic-facing U.S. companies with limited foreign exposure, nearshoring beneficiaries like Canada, Mexico, and India, defense and infrastructure plays that benefit from increased spending in defensive bills, utilities and healthcare always provide stability through volatile markets, and alternative fixed income through sukuk and inflation-protected securities. Now, let's talk about portfolio protection. This requires geographical revenue diversification, not just asset class diversification. So we're not talking about just buy gold, oil, in different sectors. We're talking about within each sector, we need to look at the geographical revenue of those companies that you're actually investing in. Companies generating over 70-ish% of revenue domestically are going to significantly outperform those that are exposed internationally during trade realignment. So you need to really look down into those companies and figure out what they're doing, where their contracts lie, and where is the revenue stream coming from, because that might going to help you save a lot of money or possibly make a lot of money. The $3 trillion fragmentation in international trade is just the beginning, and I expect this to continue to rise as more decoupling occurs and more countries are focusing on de-dollarization. Which of these defensive fragmentation plays are you adding to your portfolio? Drop a comment below and let me know your thoughts. I'd love to hear them. If this analysis helped you understand the hidden forces reshaping the global markets, smash the like button and subscribe for weekly analysis that matters. Also, hit the notification bell so you receive up-to-date information on trade wars and our market picks as soon as we release them. Thank you for watching till the end of the video. My channel is still new and I would really love your support, so please share with other people that can benefit from this information. And remember that investing in this type of time requires you to focus on resiliency in domestic companies, supply chain security, and defensive posture. The companies that reposition the fastest are going to be the clear winners. In a future video, we're going to talk about Canadian stock reshoring opportunities. So watch out for that video in the next week. Until next time, stay safe, stay diversified, and we'll catch you in the next one.